The core lesson from Joe Lonsdale's lens: don't sell AI, sell measurable productivity. If you had $10,000, $1 million, or $100 million to invest in AI, the real question isn't which token should I buy or which model will break out next. It's this: at which layer of the AI pyramid should you place your money so returns come earliest and your chances of disappointment stay lowest? Joe Lonsdale, co-founder of Palantir and a bold investor at the intersection of technology, government, and finance, lays out a 5-tier map. And his answer is surprising. The gold mine sits at layer 5, where AI plugs directly into real-world service workflows and turns repetitive labor hours into measurable productivity. Layer 1, chips, the foundation. Semiconductors, interconnects, photonics. This is a capital-intensive, talent-scarce, supply chain fortified world. Winners here control parts of both the software stack and the IP ecosystem. For ordinary startups, it's nearly impossible to break in. Layer 2, data centers, land, power, fiber, cooling, PPAS, substations. Massive capital is pouring in, but margins are thin unless you have genuine advantages in energy or geography. Layer 3, models OpenAI, xAI, Anthropic. This layer runs on burn rate and scale. Unless you're Elon plus an elite team, odds of breaking through are tiny. Layer 4, software infrastructure retrieval tools, agent platforms, monitoring, security. Attractive, but always at risk of being swallowed when foundation model owners expand their ecosystems. Layer 5, applied AI in services. This is where the money comes fastest. Healthcare, logistics, legal, insurance, operations finance, places with real KPIs and cashback ROI. Why? Look at US service sector costs. Around $5 trillion in annual wages. Roughly 40% of that work could double productivity today with proper AI-driven process redesign. Even without better models, simply scaling what already works could strip out $1 trillion in costs this decade. If models improve, savings could hit $1.5 to $2 trillion. A textbook example: medical billing. When you shift from manual or semi-manual processes to a well-designed agent plus human-in-the-loop pipeline, profit margins can leap above 50%. The key is discipline, not hype. Investing smart at Layer 5, Step 1. Pick the right wedge. Find a painful, narrow slice with clear data standards, high labor costs, and measurable error risk. Healthcare, coding, denials, prior authorization, revenue cycle, logistics, freight audit, rating, exception handling, POD reconciliation, insurance and legal, intake, triage, discovery, claims, subrogation. Rule number 1, define work by SLA, not job title. Don't buy AI in general, buy first pass accuracy, turnaround time, and cost per case. Step 2, engineer the pipeline. A great pipeline isn't a long prompt, it's a controlled sequence. Classify, extract, retrieve, reason, draft, check, submit, learn. Each step needs deep telemetry, tokens, latency, human intervention rates, error taxonomy, data sources, validation logs. That raises accuracy, shrinks costs, and builds a moat of process data that rivals can't copy overnight. Step 3, integrate deeply Endure by plugging into the spine, EHR systems, Epic, Cerner, ERP, SAP, Oracle, logistics platforms, TMS, LOS, insurance core claims. The deeper the integration, the higher the replacement cost and the longer the contracts. Compliance then becomes your fortress. HIPAA, PCI SOC2 ISO. Step 4. Sell on outcomes. Stop charging per seat. Charge per result. Per claim closed, per recovery rate, per case completed within SLA. When ROI is quantifiable, proof comes fast. Deploy in 6 to 8 weeks, A/B test a single data flow, then scale if KPIs hit. At scale, many firms see payback under 12 months and NRR above 120%. The risks, hallucination, and drift. Control with knowledge grounding, real record testing, and human gates. Platform risk. Don't marry one model/vendor. Build multi-model orchestration with fallbacks. Integration arms race. Lock in early with long-term KPI-based contracts. Unit economics. If you don't optimize token usage, latency, and retrieval, revenue rises while margins shrink. Monitor weekly. Kaizen everything. Spotting a strong layer 5. Play KPIs improving continuously. Unit cost down. First pass yield up. Denials down. TAT shorter. Margins up. Clear SLA plus auditable compliance. Cross-functional team, Ops plus ML plus product, with a process owner owning KPS. Proprietary process data and labels organized for learning. Customers tell the ROI story in their own numbers. Portfolio blueprints. Growth or mid-size PE, 40 to 60% into layer 5 multi-sector plays, 20 to 30% in layer 5/4 must-have infra, 10 to 20% in layer 2 if you own a location power edge. Venture capital, hunt layer 4 standards, take 1 to 2 bets in layer 3 with asymmetric edge, spread the rest in fast payback layer 5 startups. Family offices, prioritize cash flow, outcome-based contracts, hard SLAS, and deployers with a proven track record. Unit economics in action before AI, $4.20 per claim, 92% accuracy, 72-hour turnaround. After 12 weeks with an agent pipeline plus HITL plus EHR integration, $1.80 per claim, 97.5% accuracy, 18 to 24 hours TAT, gross margin up 12 to 20 points. When expanded to multiple sites, costs drop further thanks to playbook reuse and process data leverage. That's layer 5 scale. Red flags promising 100% automation without human gates, boasting whole industry coverage with no specific wedge, single model dependency, or missing telemetry to measure unit economics. A smart investor dives into logs, which sources the model calls, what guardrails exist, where humans intervene, and how contracts tie to KPIs. Don't believe stories, believe metrics. The core lesson from Joe Lonsdale's lens: don't sell AI, sell measurable productivity. At layer 5, the debate isn't which model is better, it's how much did cost per claim drop in 90 days? How much did first pass acceptance rise? How much faster did cash arrive? When your pipeline answers those 3 questions, the money shows up automatically, and your moat grows through process data, deep integration, customer habits, and a team trained for weekly improvement. Action map. If you're a founder, choose a clear SLA wedge. Build agent pipelines with guardrails and human in loop. Integrate deep early, sign outcome-based contracts to prove ROI, measure, learn, improve every week. If you're an investor, demand before-after unit economic tables, SLA plus audit proof, pipeline logs, and customer testimonials. Trust companies that talk less about model magic and more about denial rates, acceptance ratios, processing time, and cash flow. Those are the firms that pay you with reality, not slides. Closing investing in AI, the Joe Lonsdale way, isn't about timing the hype. It's about placing disciplined bets where productivity explodes and value is measurable. Layers 1 to 3 belong to those with scale and privilege. Layer 4 to a few geniuses who set new standards. Layer 5 is wide open for builders who measure honestly and put customers and process ahead of models. If this video helped you see the map more clearly, drop a comment. Which layer are you targeting, and what KPI will prove ROI in 90 days? Don't forget to subscribe, turn on the bell, share this video with your friends, and like it so we can keep breaking down real deals, real KPIs, and real playbooks, so you don't have to pay tuition to the market. Thanks for watching Billionaire Investment. See you in the next episode.